Hello and welcome to AtQuest. This is yet another lecture of our Freshers series. In this Freshers series, we will be covering basic concepts of finance and economy. So with these basic concepts, you will be able to better your preparation and you will build your all preparation around these basic concepts. So our main focus would be to understand very fundamentals. So in this lecture, we will be discussing basic about equity, which we alternately also call as share. So let us see what is this equity or share is. So imagine we are establishing EdQuest, that is I am establishing EdQuest. So this is my organization through which I want to provide educational courses. To establish EdQuest, I need some money. Why would I need some money? Because to make courses I would need to buy some computers and also I'll need some books. These are my requirements. For that I'll need some money. Let us say I need some 1 lakh rupees. With this 1 lakh rupees I would be able to buy all my provisions and then only I'll be able to function and create courses, right? So this is me. I need 1 lakh rupees and right now I only have 50,000 rupees. With this 50,000 rupees I'm quite sure that I really cannot do much, because in 50,000 rupees I'll not even be able to buy a good computer which would solve my problem of recording lectures. So I'm in search of money. I need yet another 50,000 with which I'll be able to complete my provisioning and I'll be able to start my lecture recordings. Okay, so let us see from where I can get some more money. I have one option, that is to go to bank and ask bank, sir, please give me some money. But we all know in general how our banks are. But in this particular case, my business is really very new. I actually do not have any credit history, or even I do not have any functioning history where it will be established that I can make some profit. So why would be bank lending me? Bank would find someone when bank lends that particular person, there will be lesser risk, because I am a new business or I am establishing a new business. Certainly there will be a higher risk, and that is why banks would be in the first place, they would be reluctant to lend me. They will not give me money so easily. So that is about banks. But even if banks give me money, what that money of what kind that would be? There would be very high interest. If you go for any business loan, you will find that interest ranges from say some 11 to 12% to even up to 20-25%. So it may happen, as my business is very new, bank would say, sir, we give you business loan but just pay us 25% of interest per year. And you can understand how terrible that would be for me. Bank can give me another option. Bank would say, okay, we will reduce some interest rate, let us make that some 15% or even 18%, but in that case you will have to give us some collateral. Just understand the way we get housing loan. When we get a housing loan, banks gives us loan for buying a new house, but the moment bank gives us money, it impounds our papers. So whatever papers or registry papers you have for your new house, they are kept with bank as long as you do not repay your loans. So that is how collateral works. In this particular case, I if ever I had something to give as a collateral, I would have like liquidated it and exchanged it for money from someone, or I might have sold it and then only I would have invested all that money in my project. So that is not the case, and that is why it will be very difficult for me to get any loan from bank. Now let us see what is another option I have. So another option can be go to some relative and tell him or her my business idea. So the moment I tell that person my business idea, that person might even consider it laughable, that see, this is like, you cannot do it, you should not do it, this might not work. And that person might be afraid of losing money, so he again would be reluctant to lend me any money. So let us say even that option has collapsed. Now you are my friend and I know you are very reasonable person. So you come into the picture. You also have some extra 50,000 rupees in your bank balance. So I approach to you and I tell you, see, give me 50,000 rupees and I will give you equal share in the project I am building right now. So with 50,000 rupees taken from you, 50,000 rupees from me, I'll total have 1 lakh rupee, right? And with this 1 lakh rupee, I'll be able to establish my business, that is EdQuest. Okay, so let us assume that you have given me that 50,000 rupees, but not as a loan, but you will be interested in making a partnership in my business or my establishment. So that is your share, that is 50,000 is your share you have contributed in this particular project. So that makes a partnership as right now 50-50. So you hold 50%, I hold 50%. So that is how we have built a partnership, right? And with this partnership we will establish a project. Now let us move to next year. So next year what happens, sorry, next year what happens is I end up making, or we end up making a lot of, or let us say some profit. So what is that profit? Let us say we have made some 10,000 rupees as profit. Now with this profit we decide that, see, we both had equal share when we invested in this particular business. We both had equal share. So when it comes to profit, let us divide it in equal. So you get the one half, that is 5,000 rupees, and I get another half, that is another 5,000 rupees. So this is how in this partnership we invested equally, and when it came to return or earning returns and whatever returns we have got, we have divided it equally. So you got your 50%, I got my 50%. So that is how we can say this particular partnership works. Now in this case what we can simply say that, see, you hold 50% of the shares of the company and I hold 50%, another 50% of the share of the company. So I hope this is making some sense. We really have not clearly reached to the idea of equity, but in very rough sense this is how equity works. So it is your share or my share, it is the sharing of this particular investment part, right? So I hope this makes some sense to you. With further elaboration I am sure that you will get basic or the basic concept of equity and share. So let us move some more ahead. So when we bridge this partnership, what is the advantage for me in this partnership? So when you gave me this 50% rupee, 50,000 rupees, you particularly agreed, see, I am giving you 50,000 rupees and I am not going to take that back in any near future or never. Like when we say this about equity, so the money invested in equity never comes back. So when you gave me 50,000 rupees, every single year whatever profit I will be making, I will give you your share of profit. I will not be giving you back your original 50,000 rupees. So the advantage for me in this partnership was I never have to repay you back those 50,000 rupees. So this is one very simple advantage for me. What is another advantage? I will pay you part of profit, that is what we call as dividend. So this is when we are saying that we will divide this particular profit, whatever profit we got, we will divide it into what respective shares of ours. That division we call as dividend, right? And whenever we make profit, then only I'll have to pay you dividend. If there comes an year where I do not make any profit, I'll not simply be paying you any dividend, right? So this is yet another advantage for me. So in case I make losses, I would not be obliged to pay you a single penny, right? Another important aspect which we need to understand in this particular equation is that, so this is not this is most important advantage. So I earlier only have explained that I am not going to pay you back for whatsoever reason in future. So maybe 50 years ahead, 100 years ahead, I'm not going to pay you back. So this is very clear. Okay, when I have said that there are certain advantages to me, that is, I have told you I will not have to pay any dividend when I do not make any profit. Your money will be with me for a lifelong period. Also, I'll in any way I'll not have to repay you back anything, right, out of your 50,000 rupees, and I'll be only paying you dividend as and when we make profit. So this is simple deal, this is simple advantage I am receiving. But when I am receiving advantages, I must also be having some disadvantages, which, so in this particular case, what would be the disadvantage? The disadvantage would be when we made into, or when we stepped into a partnership, I lost 50% of ownership. So 50% of ownership lies with me and another 50% of ownership lies with you. And this is my loss. Had I not taken money from you, had I went to bank, bought some money, what let's say what at whatsoever rate, even at 25% rate, even then whatever decision making and whatever part I had to play or whatever profit it would have come, that would have been all mine. I wouldn't even have needed to ask you anything. Had I even borrowed money from you in uh, in place of partnership, even that case, it may be that we would have made a deal. Let us say I would pay you some 8 to 10% per year, and in couple of years, as and when it is possible for me, I would return your money. Even in that case, I would not have made you a partner, or I would not have shared 50% of my ownership in this whole project. So let us understand that when there are advantages, there is a disadvantage for me, that is I would be losing 50% of this ownership, and that is your advantage as an investor. That is your advantage. So whenever we say a shareholder or an equity shareholder, we are calling that person as an owner. So when in very formal words, when we define share or equity, we also call it as ownership, and that is one part of the equity. So I hope now it has again started to make some sense to you, right? So in till this point we only had two people, and we our equation included only a sum of 1 lakh rupee. Now let us move a few years ahead. A few years ahead, what my wish is, and I hope even you wish that EdQuest will expand it really very big, right? To expand it, we'll certainly need some money again, and this time it is not about 50,000 rupees. This time this is really big money, and that money is 1 crore rupees, and in no certain ways you and me both can get this money, right? So let us be very clear about it. So again we will go and explore our options. So let us see what options do we have. The very first option, as always, we can go to bank, and as I have earlier told you, bank would charge hefty interest again. So if you think that you have got functioning history, then bank would like reduce some interest rate, that would be very nominal unless you provide some handsome collateral, and that is not an option right now. And even if we get money, I'm like, we both are not interested in borrowing at such a high interest, right? So let us throw away that option. Now certainly we cannot go to relatives. Nobody has like 1 crore rupees to lend you. So what best option we do find? Let us go to public. Let us find, say, some 1,000 people or even 10,000 people who can, let us say 1,000 people who can contribute some 10,000 or whatever money they can, and with their money we will collectively make 1 crore rupees, right? And we will give some share to them. So right now we will not be going into that calculation, or like say what percentage share do we have to go. Let us say we assume that this is valued, this Edquest is worth 10 crore rupees when we are going for an expansion, and we are raising some 1 crore rupee from these people. So certainly these people will get 10% of the ownership of Edquest, and we too would be left with say 90%, right? So this is where whenever we need a lot of money, we go to public, and these are the people who get ownership into your company. So you can clearly see it that once you take money from them, give them share, they also become partner, if not equal but partner in your company. That is the shareholder, right? I hope now again you can understand what we are going with. So let us see what again advantage we have. As we earlier said, when there is no profit, just pay no dividend to people. You really have not to pay any dividend. When we will make profit, huge profit, let us pay these people part of their profit. So whenever you will make some, let us say, if you make 10 crore profit, so 9 crore will come to you, and remaining 1 crore will go to these people who are holding share or ownership of your company. I hope now you can understand what share or equity means in a company, and the money which we are giving in proportion out of profit to these people or these shareholders, we call it as a dividend. So separately also we will understand what dividend is, but for now just have a rough idea like that. Okay, so this is how shareholders interests are taken care of, and I hope you have got the very fundamental or the conceptual part of share or equity. Now when we are studying share or equity, what other parts we need to go through? So earlier, right now we have gone through concept. Now there are types of share, right? When we say types of share, there are a lot of types of share, a lot of variation. Various country have where, like, this is very innovative space. Finance in general is very innovative space, so there are like a lot of innovation, there are a lot of very innovative financial instruments, and as and when we go through whole syllabus, we will understand how innovative instruments are available. But for the matter of discussion now, let us see that types of equity include ordinary equity, or there will be a preference share, or there will be bonus share, sweat equity, so on and so forth. So that is what the next part we are supposed to understand when it comes to equity. Then once we have understood these types of equity, we will go through the process of issuing of equity. The process of issuing of equity is really very important when you are preparing for any exam of a regulatory body, let us say RBI grade B or SEBI grade A. There is a lot of emphasis on process, because the process itself is controlled or regulated by all these regulating body, and they are interested whether you know the process part or you do not know. So when we say about process of issuing equity, equity can certainly be issued in this a few examples I have mentioned, that is initial public offering or further public offering. Then there is another way, that is private placement, rights issue, preferential shares. So these all are concepts which need a detailed discussion in themselves. If you want to try, you can, once you have, like, I hope you have understood what equity is. So when you have understood equity, try going through or try googling these topics and just see if that makes sense to you. If that does not make sense to you, you can certainly ask me, we will work on those things together. So let us move. What next we will be going through, the next part would be regulation. So when all the syllabus, whenever we are preparing all this finance syllabus, one thing we need to really understand, that we are preparing for an exam of a regulatory body, be it SEBI or be it Reserve Bank of India. These are regulatory bodies, and because these are regulatory bodies, you should be aware of regulations and what regulatory process is involved in all these matters. So I hope with this lecture I am able to make some sense, and I have imparted basic knowledge about equity. So I am not claiming that you have mastered equities, but certainly I am assured that you have understood what is the basic concept of equity, and in your self study part what else you will need to go through, and how concepts you will further will need to build around equity. I hope this was helpful. If you have liked it, kindly like, share and subscribe. Thank you.